Time, it's one thing we never seem to have enough of. But what if I tell you by the time you finish watching this video, you could have a share of all the top 500 companies in the US in your hands? All you need to remember is the term S&P 500. Now, for starters, S&P 500 stands for Standard & Poor's 500, which is a stock market index, kind of like a basket that holds shares from 500 of the biggest companies in the US, like Apple, Google, Microsoft, all the big boys you know. And it's such a big deal that even a working paper by the US Securities Exchange Commission quoted S&P 500 as the benchmark for mutual funds performance. Sounds really exciting, right? Now, here's another good news to make your life much more easier. You don't actually have to buy shares of each of these 500 companies individually. You can actually sapu all of them at once through something that we call ETFs, exchange traded funds, and even without the need to do the extensive research. Very simple, right? So in this table, I have drilled it down to the 4 most popular US-based S&P 500 ETFs. But wait a minute, what are there for? Not only one S&P 500 man? Yes, that's because there are actually thousands of fund providers in this world, and some of them are the famous ones like Vanguard, iShares by BlackRock, Fidelity, State Street, etc. And of course, each of them would want to offer their own version of an S&P 500 ETF, which is good lah, more choices for us investors, right? But okay, now how do you actually know which one to choose, right? Well, the first thing you should always pay attention to is the top company holdings of the ETF, meaning you look at which company they put most of their money in. For example, right now, out of the 500 stocks, large cap growth companies, mostly in the tech sector like Apple, Microsoft, Tesla, already takes up the majority of their portfolio at about 20% in all of these 4 ETFs, as you can see over here. So if you foresee these companies to take a downturn in the future for whatever reasons, then these ETFs could be negatively impacted. But the good thing about an S&P 500 ETF is that you are super diversified, because don't forget, besides technology, you also have shares in other sectors like healthcare, finance, consumer goods, and so on. And an interesting fact, the S&P 500 also goes through a quarterly rebalancing, which means they may decide to add or remove companies based on their market cap, liquidity, etc. Because just like how your phones require software updates, the S&P 500 also needs updates too, and they periodically remove losers and add in more winners into their portfolio. And next, once you have found the right index, we should look at the ETF's expense ratio, which is generally the fee you pay yearly to the fund manager for helping you manage the ETF. So in this case, say the S&P 500 was up 12.64% in the last year. If you buy the SPY ETF, you will have an expense ratio of 0.09% per annum, which is to be deducted from your expected return of 12.64% instead, which is 12.64 minus 0.09%, then you're left with 12.55%. So yes, the logical way to see this is the lower the expense ratio, the better, right? Well, yes and no. This is where we look at the third factor, how liquid, or in other words, how easily the shares can be bought or sold in the stock market. And a common benchmark is to have at least $10 million worth of assets under their management. And any ETFs with assets below this threshold means there will probably be no or less interest from investors, which means very poor liquidity and very wide trading spreads. And for this, you can see that SPY has the highest asset under management of $417 billion and has the highest 30-day average trading volume of over 70 million shares, despite having the highest expense ratio of 0.09% as compared to the rest at 3 to 4 million shares. So this SPY ETF definitely suits active traders more as compared to long-term investors. So if you're more of a buy and hold kind of investor like me and most of the people out there, then it will make more sense to go with the ETFs with lower expense ratio like IVV, VOO, or SPLG ETF. After all, trading costs can really eat into your profits if you are not careful. So why pay 0.09% when you can pay 0.03%? Okay, now that you have decided on an ETF, the last point to consider is the unit share price cost. As you can see here, both the SPY and IVV ETF are priced around $450 per share, which is about 2.1k ringgit, whereas for VOO it's priced around $400, which is about 1.8k ringgit, but for SPLG it's priced around $52, and that means it's around 250 ringgit only. Very affordable for a lot of starters if you ask me. Now, I'll be showing you a quick tutorial on how you can buy any of these US S&P 500 ETFs using ringgit in the fastest and safest way possible. And in this case, we will be using 𝗠+𝗚𝗹ble, which is the sponsor of this video. They are an online stock brokerage app that's fully licensed by the Securities Commission Malaysia, allowing you to buy US stocks and US ETFs, and you can easily fund your account using ringgit through online FBX within just 2 minutes. And thanks to them, you can now get a guaranteed free 𝐾𝐻 ETF worth $30 and another free stock or trading voucher once you deposit 1,000 ringgit in your 𝗠+𝗚𝗹ble account, and the free stock will be transferred to your profile within 7 working days. And you can do all of this through the link in the pinned comment down below. So once you have signed up, you will see your watch list right over here. So just click on the search icon and type your desired ETF, say SPY. Then click on the buy button here, and this is where you will fill your order. And next, click on the buy button. Choose your order type. For limit order, it means you want to only buy the stock at this fixed price, and in this case it means you want to buy SPY at $445. And as for market order, you don't care what the current price is, you just want to buy the stock immediately. So if the current market price is $450, then that's how much you will be buying then. Personally, I prefer limit order so that I have more control over the price, because who doesn't like the control, right? So lastly, fill up the quantity and hit buy, and that's it. You are now a proud owner of the top 500 companies in the US. Congratulations. So which ETF should you ultimately go for? If you are looking for the cheapest price one, I say why not try the SPLG ETF for a start. But if you have some budget and you want the highest return thanks to their massive assets under management, then my personal preference would be the VOO ETF by the Vanguard. And if you are looking to understand what kind of taxes you will be imposed after you have bought the ETF, then check out this tax guide video that I have made where I cover all the taxes you need to know about as a US stock investor. See you over there.